How does an institution with no army, no voters, and no direct control over any country still end up shaping budgets, fuel prices, tax policy, and investor confidence? That institution is the IMF. And its real power is not just the money it lends. Its real power is the ability to tell the world whether a country looks safe enough to trust again. The IMF was born in 1944 at Bretton Woods. After depression and war, countries wanted a more stable financial order. Exchange rates would be linked to the dollar, and the IMF would help keep that system steady. At first, the IMF was more referee than ruler. Its job was to watch the rules, not redesign economies. Then the system it was built to protect started falling apart. In 1971, the United States ended the dollar's convertibility into gold. Bretton Woods started collapsing. This should have made the IMF less important. It did the opposite. In 1978, Article 4 was rewritten. The IMF was no longer just watching one exchange rate system. It now had a broader role, monitoring the international monetary system and member policies. That might sound technical. It is not. Surveillance means recurring public judgment. IMF reports started to matter because governments, investors, and lenders all wanted the same answer. Is this country stable, or is it drifting toward trouble? Then came the crisis that turned the IMF from judge into crisis manager. In the late 1970s and early 1980s, borrowing countries got squeezed from both sides. Oil shocks had already hurt them. Then US interest rates surged. Debt payments exploded. This was the world of the Volcker shock. Rates went sharply higher, and heavily indebted countries suddenly found it much harder to survive. Then Mexico cracked in 1982. That was the turning point. The IMF role changed fast. It was no longer just watching the system. It was now helping manage sovereign debt crises in real time. And this is where its power hardened. Not because it had endless money, but because everyone needed one institution to coordinate the rescue. The country in crisis needed funding. Banks wanted reassurance. Other lenders wanted a framework. Investors wanted a signal that someone was in charge. The IMF became that signal. That is the real controversial point. The IMF became powerful because global finance started treating IMF approval like a credibility certificate. The fund was not just lending money. It was telling the world that a country had a plan, that the crisis was being managed, and that private capital might be safe enough to return. That is a different kind of power. In a global financial system, countries do not just need cash. They need credibility. They need bond markets to stay open. They need lenders to keep rolling over debt. They need the world to believe the situation is under control. The IMF became the institution that could help create that belief. And the more global finance grew, the more valuable that signal became. Today, trillions of dollars move across borders through banks, bond markets, and financial centers. In that kind of system, trust is not just psychology. Trust is infrastructure. That is why IMF power is bigger than its balance sheet. Its biggest weapon is not just money. Its biggest weapon is the ability to shape confidence. And the proof shows up in a rather unusual place: sovereign bond filings. If you want to see how IMF power works in the real world, do not just read speeches. Look at what governments tell investors when they sell debt. In Turkey's sovereign filings with the US Securities and Exchange Commission, IMF Article 4 consultations are presented as part of the country's macroeconomic framework. In other words, IMF surveillance is not treated like background noise. It is treated like something investors should know. In some filings, IMF membership itself even appears in language tied to default risk. That tells you something important. The IMF is not only a lender of last resort, it is also part of the architecture investors use to judge sovereign risk. Turkey's filings from the 2009 period show another side of this. IMF talks appeared alongside references to broader support from institutions like the World Bank. That is the choreography of crisis management. IMF negotiations can help unlock wider confidence wider financing, and wider coordination. Argentina's filings show another layer of IMF power. There, the IMF appears not only through lending, but through data standards. Argentina told investors it subscribed to the IMF's Special Data Dissemination Standard, a framework meant to improve the quality and timing of economic data. That matters because one form of IMF power is informational. The IMF does not just lend. It also helps shape what counts as credible state data, credible policy, and credible reform. So IMF power works through three channels at once: money, conditions, and signaling. And that third channel is the least visible, but probably the most important. This also explains why so many countries hate the IMF. The IMF says its conditions are there to restore stability and avoid an even worse collapse. That is the official case. But to the public, those conditions can mean subsidy cuts, tax hikes, wage restraint, privatization, and reforms pushed through at the worst possible moment. Austerity may look technical in a policy memo. It feels very different in real life. It can mean higher fuel prices, more expensive electricity, lower public spending, political anger, street protests. And the criticism is not just rhetorical. Even inside the IMF system, there has been serious concern about how conditionality has worked. Internal evaluation found that many structural conditions were too detailed, too intrusive, and often poorly implemented. That gets to the heart of the backlash. A country in crisis does not experience conditionality as theory. It experiences it as pressure. So the IMF became powerful for one reason and unpopular for the same reason. It became powerful because markets believed its approval mattered. It became unpopular because that approval often came with painful demands. Argentina in 2018 is one of the clearest examples of the IMF's promise and its limits. The IMF's program there became the largest standby arrangement in the fund's history. The goal was clear: restore confidence, stabilize the situation, and help capital return. But the program did not deliver on its objectives, and that shows the trap built into IMF power. The IMF is powerful because markets believe its endorsement can calm a crisis. But when confidence does not return, the IMF is left owning the political fallout. That is why the institution can look powerful and fragile at the same time. Powerful because everyone watches what it says. Fragile because its influence depends on belief. There is one more layer to this story. The IMF speaks in technical language, but it is still a political institution. Major IMF decisions can require an 85% voting threshold. The United States holds more than 16% of total voting power. That gives Washington de facto blocking power on the biggest decisions. So even when the IMF presents itself as neutral expertise, its structure still reflects geopolitics. That matters because many countries do not just see the IMF as a financial institution. They see it as part of a wider global hierarchy, shaped by the interests of the most powerful economies. And yet, despite all the anger and distrust, countries still keep coming back. Why? Because the world that made the IMF powerful still exists. Capital still moves fast. Bond markets can still shut suddenly. Governments can still lose market access in weeks. And when that happens, everyone still looks for the same things: emergency funding, coordination, and credibility. The IMF is not a world central bank. It does not need to be. Its power comes from being official enough to coordinate states, large enough to matter, and credible enough that markets still react when it steps in. So how did the IMF gain so much power? First, it survived the collapse of the system it was built to manage. Second, it became the coordinator of debt rescues. Third, global finance turned its approval into a market signal. And over time, every crisis reinforced that same habit. When a country is in trouble, lenders, investors, and governments all wait to see what the IMF will say. That is why the IMF became the institution countries love to hate. Not because it rules the world alone, but because, in a crisis, it became the institution that decides whether a country looks stable enough to trust again. And in global finance, that kind of judgment is power.